All right, welcome everybody to our discussion today on the One Big Beautiful Bill, which I will refer to as the OBBB from this point forward. Let me start with some introductions. For those of you who don't know me, my name is Scott Walschlager. I'm the CEO and one of our senior financial advisors here at MPPL Financial. With me today is Brian Resch. Brian Resch is one of our managing partners and financial advisors here as well. He has a deep background in finance and our industry, and it all started as an honors graduate from the financial markets program at the University of Minnesota Duluth. He works with both individual and businesses navigating their legal, financial, and tax opportunity and challenges. And he'll be a great speaker for today's topic on the tax smart planning ideas of the OBBB. So with that said, let's jump into the presentation. First, we got to start with a word from our attorneys and compliance people. I'll give a second for everybody to look that over. All right, and with that, let's get started. So as far as the agenda goes for today, we are going to start off with a quick overview on the OBBB. Then we're going to get into the 7 tax smart planning opportunities we have, and we'll leave some time at the end for question and answer. A number of you have submitted questions ahead of time, and we intend to address those. But if you have questions along the way, there should be a question and answer window or button on your screen. Feel free to type questions you have into that section, and we'll try to get to as many of them as possible as the presentation goes on. All right, so let's start with an overview. First thing I'd like to address is some confusion. Because of the Tax Cut and Job Act that was passed by President Trump under his previous administration, there was many parts of that sunsetted in 2026. So I think a lot of people assumed the OBBB was going to pick up where that one left off in 2026. But in actuality, many of the provisions of this go into effect now. And there's actually some things that are getting eliminated that happen at the end of this month. So it's really important we're aware of these provisions today and we're ready for the things that are coming. But I'd like to start out with talking about some things that have not changed. So one of the big things was the Tax Cut and Job Act was going to sunset in 2026, and with it, the personal income tax rates were going to go down. Well, those have now been made permanent or extended. So the tax rates that we've become accustomed to under the Tax Cut and Job Act will continue. There are also a number of opportunities and tax cuts that are part of the OBBB that we're going to talk about. But we have to remember about anything in this bill. I joke it's permanent, and it's permanent in that it is there until something changes. But if we know anything about Congress and government, is that things tend to change. And so although we're going to talk about a number of provisions in this bill that are permanent, we have to appreciate that things will change. So with that said, I'm going to pass that over to Brian, and he's going to start our presentation.
Sounds good. Thanks a lot, Scott. So, this is quite a piece of legislation, right? It's 331 pages. There's an enormous number of provisions in this bill. Some of them provide immediate and future planning opportunities for virtually all of our clients. And so in our discussion today, we'll not be able to address every potential planning strategy that comes out of this piece of legislation, but we've chosen to highlight a handful here, including some Roth conversion strategies and estate planning strategies for those that are approaching or currently in retirement, some tax reduction opportunities for business owners, saving strategies for families with children, and some tax avoidance opportunities for the middle-class families, really of any age. And then, as Scott highlighted, there's a number of things that are sunsetting, some very soon. And so we're going to touch on a few pre-existing tax incentives that are going away over the coming months, some of which expire within a week of today's live event. So starting off, we want to look at Roth conversion strategies. Now, Roth conversions, so that everyone understands exactly what we're talking about here, this is the proactive transfer of retirement dollars from a pre-tax or traditional non-deductible retirement account to a Roth account. The primary tax benefit of a Roth IRA is that once the account has been established and funded for at least 5 years, the growth of the investments within the account and the contributed principal are both treated as tax-free when withdrawn. So for most clients that we've done financial planning for in the past, there have been some recommendations regarding Roth conversion planning as either an immediate strategy or a deferred strategy, depending on their life stage. The concept is to use pre-tax contributions in the present as a way to maximize deductibility of initial retirement contributions during years of relatively high marginal tax rates, and use future conversions to trigger taxation of those dollars in years when a household's projected marginal income tax rate is meaningfully low. So the bill improves usefulness of this strategy in several respects. The lower tax rates that were initially set forth in the 2017 Tax Cuts and Jobs Act, which would have expired after 2025, were made permanent. And this not only provides for lower tax rates on future conversions, but it provides more clarity about what future rates might be, which enables more confident planning strategies requiring less hedging of your bets when anticipating future tax rates. So expanding standard deductions, especially for those age 65 and over, increases the amount that can be converted within a given tax bracket. So also impacting the amount that can be converted within a given tax bracket is increases to the caps on state and local tax deductibility. So that's really beneficial. The bill leaves the key backdoor Roth conversion strategy that we've used for many higher earning clients in place. So workers earning above the Roth contribution phase out levels are still able to make non-deductible IRA contributions and then later convert those to Roth under the provisions in this bill. But no matter how you look at it, the complexity of Roth conversion planning has definitely increased under this new legislation. There are multiple additional income levels where deductions, contribution eligibility, and phase out levels make the planning side of this very technical. But our team's experienced in navigating these exact complexities. So as your advisors, we are well positioned to guide you through the necessary decisions when pursuing an appropriate Roth conversion strategy. So with that, I will pass it back to Scott to cover the next few planning opportunities.
All right, so the next one we're going to talk about is specifically geared to the business owners that are on this call. So there are a couple key provisions that have been expanded or made permanent. And again, I'll remind you of the comment of permanency. It is for now. But a big one that was set to expire under the Tax Cut and Job Act is this thing called QBI deductions that were eligible for pass-through entities like S corporations, partnerships, and LLCs. These were intended to go away, and now they have been made permanent. And if you think about this, this was sort of to level the playing field with the C corporation tax reductions that were made permanent under the Tax Cut and Job Act. So having this be stable gives our pass-through entities, which tend to be smaller entities, generally speaking, a tax break and also some permanency, so they don't have to expect these changes in the future. But one of the big changes for business is this 100% bonus depreciation. So bonus depreciation is something that's been around for years, but it's been moving up and down over the last 5 to 10 years. It is now locked in at 100% and permanent. This allows businesses to buy equipment, expand their business, grow their business, do certain capital investments, and get a deduction all in the first year. So obviously, if you're a business trying to buy a new piece of equipment to grow your business, this is a big win. It decreases the current year cost of buying that equipment or growing your business. And so the goal of this provisional change is to really increase growth in the U.S. economy. And the bonus depreciation, I think, does good at that. But we have to be aware of a couple things on bonus depreciation. One of them is that if we buy a piece of equipment, if we're a small business and we buy, let's say, a car or a piece of equipment for our business, but we are expecting to use that piece of equipment for personal use in any way, shape, or form, we cannot take the 100% depreciation. So let's say you buy a car and you're going to use that 20% personal. Even though you could deduct 100%, you have to be careful only to deduct up to the 80% threshold since you're going to be using it 20% personal. But the 100% bonus depreciation is a really big win for businesses, helps them grow and expand their business while taking the cost of those improvements down because they don't have the tax bite to hit along with it. Now, if we talk about the other thing here is that it can also help us control taxes. And when you do this in coordination with, say, some of the examples Brian was using about Roth conversions in the previous slide, we could potentially use bonus depreciation to buy a piece of equipment or improvement of our business, which decreases our business's taxable income or flow through to our personal tax return, which also opens up more opportunities on the personal side for things like Roth conversions. So we have to appreciate when we look at these items we're talking about today, it's not always just one of them. Sometimes we can combine multiple of them together to get the bigger bang for the buck on the tax savings. The other big change is the domestic R&D or research and development benefits here. So for years, we could deduct research and development costs all in the year it was incurred. But more recently, those have been forced to be spread out over a number of years, resulting in a higher tax rate for those businesses who are doing R&D. The new tax bill, the OBBB, makes some pretty substantial changes to the R&D world here. In that they create a fork in the road, and they're now separating between domestic R&D and foreign R&D. So if you're a business and you hire people and you're doing your research and development here in the United States, you can now choose to take those deductions all in one year, where if you are doing the R&D foreign, you have to go under the old rules. And that is to spread them over many years. Obviously, it is trying to encourage research and development on U.S. soil to improve our competitiveness and growth in the U.S. economy. But there's something that happened here that is really unprecedented and unusual in that the IRS, they're opening up a window to take previous R&D expenses that were expected to be capitalized over many years and essentially either amend tax returns for previous years or bring those expenses into 25 or 2026 to get the deductions faster. This is pretty unusual, and I will tell you the IRS still hasn't given full guidance on this change. So if you are a business doing research and development, it's going to be important that you watch some of the IRS rulings that are coming out on this topic because it is not totally clear how they're going to deal with this. The last thing I'll point out, and it also hits on the topic Brian was just talking about, but with the state and local tax deduction limit increases, that has provided some help to many individuals, especially people in higher tax states. But for business owners who have a state and local property tax deduction problem, meaning they're getting capped out on those limits, they can use a thing called the PTE tax workaround by essentially electing to pay state taxes at the entity level. Normally in a pass-through entity, you would pay the tax at the individual level and you'd be subject to those caps. But because of this PTE workaround, you're able to pay the tax at the entity level and therefore avoid the caps on the SALT taxes. So these are all valuable strategies for business owners to help control and mitigate taxes in the current year, and hopefully use some of those those savings to grow their business and increase our economy. Next thing we're going to talk about is estate planning. So for many years, we've been dealing with a very high estate tax threshold, but there was always this idea that it was going to revert back to a lower threshold. They have now made that permanent, and they've actually increased it to 15 million per individual and 30 million for a couple, and that is indexed for inflation going forward. Again, remember, this is not necessarily permanent. If you look at the estate tax rules over the last many years, it's been like the political football that keeps getting shoved up and down. So not only have the exemption levels went up and down, the rate of tax over time has also changed. So we have to be careful that things could change in the future. And when we're staring down the barrel of huge debt levels in this country, it's very possible estate tax thresholds or the taxes associated with them could go higher in the future. That's why it's valuable to take action when the window is still open, and that's kind of what we're hitting on here. So there's been some legal precedent, and the IRS gave us some what we call the anti-clawback rules, which basically says if we take advantage of an estate tax exemption today and future estate tax exemptions are changed, they are not going to claw back the difference. So if we use an example and we use this $15 million level for an individual, and 5 years from now that level gets brought down to $5 million, we're going to have benefited by using the 15 million today, and we're not going to lose what was clawed back. And so that is kind of the opportunity of the day. The challenge here is this. A lot of people might not be at that estate tax thresholds today. Obviously, these are easy discussions if we have estates that are over 15 million of individual or 30 million of couples, because you can benefit from this planning today. But some of our clients who own businesses that are growing rapidly or have large investment portfolios that are outgrowing the rate of inflation, it's very possible in the future you could exceed these estate tax thresholds. So in this situation, we use financial planning for clients to help project out their current growth of their assets and their business to try to figure out if they will have an estate tax in the future. And then we come up with kind of a present value of the assets that we think will exceed those thresholds, and we can use those in estate planning techniques today. On the slide, you'll see a couple of the advanced planning options we use for this, things like SLAT, intentionally defective grantor trust, or GST, generation skipping trust. Essentially, we're talking about irrevocable trust, which means we are making a gift from our estate to a trust. And in the year of that gift, you are usually lowering the amount that you can pass in the future under these estate tax exemptions. And by doing that, all of the growth of those assets in the trust will then be not subject to estate taxes. So in this example, let's say we have somebody who is not over the estate tax threshold today, but we expect them to be in the future. We could potentially move $1 million or $5 million into an irrevocable trust. And doesn't matter if that irrevocable trust then grows to 30, 40, or 50 million over their lifetime. That growth will not be subject to estate taxes. And so this can be a very valuable tool for people with businesses that have a lot of growth potential built into them. And it's a valuable tool for shifting assets to kids, grandkids, and generally future generations. Okay. Now, typically, when an estate planning attorney or advisors are doing irrevocable trusts or gifting, we do a thing called gift splitting. So if we have a husband and wife or a couple scenario, and somebody's going to give 10 million to a trust, 5 million is attributable to the one spouse and 5 million is attributable to the other spouse. And that may not be the best strategy under today's environment, especially if we are concerned that the estate tax thresholds in the future might get reduced. We might instead choose to use just the estate tax exemption of one of those individuals and attribute it to that person, so that if future estate tax get lowered, at least we benefited from using up the majority of one person's estate tax while still leaving the other person's intact. The last thing I will hit on is there is a general concern among our clients, and I think rightfully so, to give money to an irrevocable trust because the theory is you can't get it back and it's irrevocable, you can't change it. This can actually lead our clients to delay making gifts to irrevocable trust till later in life and minimizing their benefits. But there is a unique tool, and we list it there, called a SLAT, where you can actually have one of the spouses make the gifts, the other spouse be the beneficiary of that trust, essentially leaving a little string attached to it. So if you ever need those assets back in the future, you could potentially get them back. And so these are kind of unique planning strategies we've used for clients over many, many years. But in a world like today, where we have these big windows of opportunity, it can also be a tool that allows people to take action without the risk of losing complete control of those assets. So now we'll shift it to Brian for the next topic.
Thanks, Scott. So the next topic we want to touch on is there's a new type of savings account that the legislation established for children. So some people are calling it the Trump account or the MAGA account, and the legislation is called the Money Accounts for Growth and Advancement. And these accounts become available on January 1st of 2026. So to be eligible to have an account established on their behalf, a child has to be under the age of 8, has to be a U.S. citizen, and have at least one parent with a valid Social Security number and work eligibility. Now, for contributions, there can be up to $5,000 per year of contributions placed into these accounts. Up to $2,500 of that contribution amount can come from an employer if the employer wishes to contribute for their employees' children. And for children that are born between January 1st of 2024 and the end of 2028, there's the opportunity to receive $1,000 of seed money from the federal government when the account is established. Now, contributions can be made up until the child reaches age 18. Once they're 18, no more money can be put in, and then the rules are going to change for how that account is governed. Now, this has to be done with a very long-term orientation if you're going to use this type of an account as a savings strategy for a minor child, because no withdrawals are permitted prior to age 18. So withdrawals after 18 can be done for qualified purposes such as education, small business startups, first-time home purchases. Up to $10,000 can be used for first-time home buyers. And after age 18, the gains are taxed at long-term capital gains rates. Now, the basis that you put in, the amount you contributed, that's not going to be taxed when withdrawn. But then beyond age 18, it starts to be governed by traditional IRA rules for any distributions that are outside of these qualified purchases where capital gains rules would apply. The one exception to the age 18 restriction is that once they reach age 17, if there is a disabled child that is a beneficiary of one of these accounts, that money is eligible to be able to be rolled over into an ABLE account. So, that's one degree of flexibility there for disabled children that doesn't exist for the rest of the population. Now, it certainly makes sense if you have a child that falls in this, birth year 2024 through 2028. To establish an account of this type, you get $1,000 of free money from the government. We're going to have the tax obligations for funding that, whether we capture that opportunity or not. So we might as well pick up that asset for the benefit of the kid. But then, beyond that, you should really discuss with your personal financial advisor whether additional funding for this type of an account is the right fit for the unique savings objectives that you may have for your family. There are some situations where your objectives might be better addressed under different account programs like 529 accounts or IRA savings rules, or even the existing UTMA or UGMA type accounts. So your advisor can help guide you towards what tool is going to be best to accomplish your unique goals. So if you do elect to open this type of an account, it's very important to do a good job of record keeping with regard to what the contributions are that you put in, because taxation of contributed basis versus appreciation is going to be different. So the current rules indicate that when you start taking withdrawals, basis, which would be non-taxable, is what's going to be withdrawn first, and then gain would be withdrawn once the basis is exhausted, and that would be taxed at long-term capital gains rates again if it's used for a qualified purpose. So one of the questions we had that came in advance of our webinar today was whether these, Trump accounts or MAGA accounts or whatever you want to call them are eligible for rollovers to be received into those accounts. And the answer right now is no. The only type of money that can be received into these accounts is new cash contributions, whether those come from the government, from parents, or from participating employers that want to contribute. So it has to be new cash coming in. So it's an interesting and potentially helpful tool, especially if you're having a new child within that 24 to 2028 time period. So one of the other provisions that's targeted at the middle class is a new auto loan tax provision. So we can call it an auto loan interest deduction. The bill calls it no tax on car loan interest. It's really structured as an above the line deduction. And, for those of you that aren't, into the technical nuances of tax rules, that means that whether you itemize your deductions on your taxes or whether you take the standard deduction, you're still eligible to take an above the line deduction, right? It doesn't require you to itemize in order to benefit from this. So the cap is at $10,000 per year for qualifying purchases. And the tax years that this deduction applies to is 2025 through 2028. So deductibility does phase out for individual filers above $100,000 of income and above $200,000 of income for those that are married filing joint. There's some really specific rules about what kind of a vehicle purchase qualifies for this special tax treatment. Now, the vehicle has to be new. It's not used vehicles that qualify. It has to be a new vehicle. It has to be for personal use, not business use. So, if you're going to be using it at all for business, that's going to make it ineligible. You have to purchase it with a loan. So, you might be in a position where you can afford to pay cash for the vehicle. but it's going to be important to work with your advisor to calculate whether it's more advantageous to make a cash purchase or to make a purchase using debt and then qualify for this deduction. This really changes the math around whether buying new or used and whether paying cash or financing is the optimal strategy. And that's going to be somewhat individual. And so we'd really encourage you to have a conversation with your advisor if you're contemplating buying a new or slightly used vehicle during this, next, 4 years, because it might make sense to take advantage of this program. Now, this isn't usable for heavy duty trucks. Gross vehicle weight has to be under 14,000 pounds. It has to be for use on public roads. So it has to be road legal. So while some motorcycles are eligible under this program, not all motorcycles will be. And it has to have at least two wheels. So while motorcycles, some of them might qualify, you can't use it for boats or snowmobiles. Sorry, got to have at least two wheels. And the final assembly has to have been done in the United States. So, it's really technical, and we'd encourage you to talk with either your advisor or your accountant as you're contemplating a purchase of this type to confirm eligibility of the vehicle that you're contemplating purchasing. Because what we often see when there's special incentive programs like this is that dealerships do a very effective job of marketing around this. And we want to make sure that you're eligible based on the tax rules, not that you think you're eligible based on the claims the dealership is making. So it's very important to make sure we get that right on the front end. So one of the other savings tools, in addition to those MAGA accounts that we already talked about, is 529 plans. If you're looking to put money away for yourself or for your children, and there's some changes in how 529 plans are working that I think are helpful to revisit here. Now, the list of eligible expenses, qualified education expenses, has been substantially expanded under this new legislation. So there are a broader set of elementary, secondary, and homeschool expenses that now qualify as qualified education expenses. This includes curriculum expenses, books and instructional materials, online educational materials, tutoring, education classes that are done outside the home, testing fees, including SATs and ACTs, fees for dual enrollment in post-secondary institutions, and for those students with disabilities, there's some educational therapies that also qualify now for use with $529, and that's new. And so that's a very helpful change, broadening out the uses of dollars inside 529 plans. They've also been expanded to be useful for credentialing programs. So we're thinking about non-degree programs, certifications, licensing, continuing education under certain circumstances. So if you have $529 perhaps that are left over after a child is done with college, there's even the possibility of reassigning some of those benefits to yourself for use in continuing education and professional programs and so forth, even during your own career. So there's a lot of flexibility here that didn't exist before. Under the prior law, you had the ability, as we saw with the MAGA accounts, to roll 529 plans into an ABLE account for a disabled child. Now, that provision was set to expire at the end of 2025, but that has now been made permanent. So that rollover to an ABLE account is a permanent provision of 529 plans now. And so that's really, really good news for those that applies to. And it also has made 529 plan contributions and rollovers to the ABLE account eligible for a savers credit for designated beneficiaries. So if you're perhaps a lower income household and you're eligible for the savers credit, then it's worth having conversations with your advisor about that eligibility specifically, because the savers credit has a variety of different credits based on income tiers, and the top tier is about a 50% credit on the contribution that's made. And so there's a substantial refundable credit that could be available there if you are income qualified. And as a reminder, anytime you're dealing with 529 plans, you have to make sure that you look at the rules for the state in which you live. Every state has their own unique rules around 529 plan contributions and deductibility. Minnesota is different than Wisconsin, is different than many other states, right? And so make sure that you understand the rules for your state. And most states assign any state tax benefits on a net flows basis. So if you put $5,000 in a particular year and you took $5,000 out in qualified education expenses, your net flow would be zero. And so that would eliminate any state income tax benefits that you might have been eligible to receive. So as the flexibility to use 529 plans for more education expenses, especially earlier in a child's lifetime, exists now, it's important to understand what that impact on state tax benefits is going to be because of the net flows rules. So with that, I'm going to give it back to Scott to bring us home.
Thanks, Brian. This one's short and sweet. We're seeing a very significant sunsetting and elimination of green energy tax rules. So if you had your eye on a new EV, now is the time. You better literally get off this meeting and run for it because you only got a couple days left. But September 30th is kind of when all those EV tax credits expire. And the deal has to be done. So we are really rapidly running out of time there. If you are doing home energy efficiency projects that we're going to get credits, those are set to expire at the end of this year. And if you're doing it for your business or commercial, those will be mid next year. And so you just have to appreciate that most of these things are phasing out, and there's we're not going to cover them here today, but there's very specific rules about putting things in service, starting projects and finishing projects by certain dates and times in order to get the credits. So if you are contemplating one of these things or getting into them, you just need to be aware of these rules up front. We have seen a lot of advertising from solar installation companies and others trying to push sales really hard right now with the idea of getting them done under the deadline. And the worry is you not only have to, in many cases, pay for them, you actually have to have them physically installed. And so I would just say, make sure you look at the fine print here. We see a lot of solar installers who bought a lot of panels who are now freaking out because they have a bunch of inventory. And again, kind of like Brian alluded to earlier with the dealerships making incentives, just because they make a pitch on a sales thing doesn't mean it's going to work out for you. And so you got to be your own advocate here and make sure you follow the rules and pay attention to those things. So now we're going to kind of wrap up with this section. So obviously we've discussed a number of opportunities. I would say if you're interested in any of these and you think they could benefit you, things like the Roth conversions and business owner deduction and 529 expansions, your financial advisor here at MPPL will absolutely be able to help you work through those and figure out if they make sense for you. If you're concerned about the estate tax things, in addition to us, obviously we're going to need to consult a trusted estate planning attorney as well for those type of things. But as always, the future is uncertain and we don't know what it's going to be in the future. So we got to take opportunities when they arise, which is kind of what this whole topic is about. So now we're going to pivot to question and answers. And I will tell you at this stage, we do have a lot of questions. I'm not sure we're going to get through all of them during the time allotted, but I will tell you we'll make a best effort to get through them here. And if we don't get through all the questions and answers before the end, we'll try to adjust them in future white papers, or maybe you can address them with your financial advisor as well. So let me start out. I'm just going to go through the list here, and Brian and I are going to take some turns going back and forth. But Brian, maybe you want to take this first one. It asks from Linda, what part of Social Security is not taxed moving forward? And if possible, could you explain the overtime tax changes? So if you have any ability to talk about that, that'd be great.
Yeah, so I can address the Social Security thing, and Scott, maybe I'll defer to you on the overtime rules. But the Social Security the Social Security impact has been much trumpeted by the current administration. And the reality is there was very little change to Social Security taxation. There was some changes to standard deductions for individuals that are 65 and over. And so if you have someone whose primary source of income is Social Security, they're going to have less of that fall within their taxable income. because the size of their standard deduction is going to have increased. But there isn't going to be an actual meaningful difference in the way Social Security itself is treated. And so, if someone has, substantial other income that is flowing through on their tax returns, there might be literally no impact to the taxation of their Social Security benefits if they're already well above those thresholds, because they've got other income sort of swallowing up the changes in those standard deductions. And so, from a Social Security tax standpoint, you're still not going to have 100% of your Social Security ever be taxable. Not more than 85% of your Social Security benefits can be taxable, regardless of what your income is. And if your income is moderate to low, you may have, 50% taxable or even none of it be taxable. But that's more of an income-driven piece versus something that's been changed by this specific piece of legislation.
Yeah, and I can hit on the overtime piece. It's not something we focused on a ton, but from what I understand, there is also income limitations on the overtime piece. If you make, you have to make less than 150 for individuals, and I think it's 300 for joint filers. Be aware though that this does not affect Social Security and Medicare taxes and state and local income taxes as well. So this is just federal income taxes, and it's only the differential, as I understand it. So if you make 20 bucks an hour and they're going to pay you 30 bucks an hour for the overtime, it's that 10 bucks an hour that is deductible. And I believe the deduction limits is 12.5 for individuals, and I think it's 25 for married couples filing jointly. This is not something I have dialed in 100%, so I would say if this is going to affect you, make sure we talk to your accountant on this topic as well. Okay. One of the things that was asked by Mike, and I think there's a couple other questions that are very similarly worded, but it basically asks how the OBB affects our investments and how it's going to affect how our investments work. So I think this is an interesting topic because the OBB is interesting in that it's kind of like the tale of two stories. The first part of the story, which is the first few years of the OBB, is what we call stimulative in the economy. And I think it was designed that way on purpose, whether political or otherwise. It was designed to give benefits in the early years of this administration. And so think about this as the extra deductions Brian's talking about, the state and local property tax increases. Many of these changes essentially create more deficits in the US, right? But deficits, are essentially good for the economy in that they're pumping more money into the financial system. And so we can expect, all things being equal, those provisions of the OBB to be net probably positive on the economy, or therefore helping our investments. That said, there are some immediate cuts to some like health insurance deductibility or health insurance premiums. That will immediately hurt people. But we think the net effect is probably stimulative and therefore positive on investments and might help offset some of the negatives of maybe like the tariff and inflation stuff we're seeing. How that balances out, it's hard to know, but generally we believe the early years should be stimulative in general. Once those first group of things though fall off, so a bunch of those deductions phase out and go away after the first 4 or 5 years, right? Then we actually get into a world where the economy, it's more restrictive. It's making cuts to Medicaid and other programs, as well as those deductions phasing off. And we think that could actually then be restrictive on the economy. When you combine that with the fact that we're sitting at massive deficits in the US, you put those two things together and it could prove to be a little challenging looking forward to the US economy. But it's also, we have to really relate to the other earlier topic of this being permanent. Well, a lot can change between now and those changes. And so I think we have to focus on the near term, and the near term is relatively good and should help our stocks and the economy in general. All right. So Brian, I think this is generally up the alley of what you were talking about, but Rob asked us, how does this bill help seniors moving money into tax-free accounts?
Yeah, so when we were talking about the Roth conversion strategies, when we're planning, we're looking at what your projected tax rates would be over every future year of your lifetime, whereas your accountant is typically looking at how do we minimize taxes in the current tax year. And so it's helpful to have both perspectives when you're trying to minimize your tax obligations. And what we're really trying to do is minimize your tax obligations as a proportion of your assets over the course of an entire lifetime, which might mean that you voluntarily pay higher taxes in one particular year because you get a disproportionate benefit in future years. And so, what we often see is that in the early years of someone's retirement, let's say they retire at 65, between 65 and when required minimum distributions would start from their IRAs and 401ks at, say, age 73. There's often what we would call a trough if we were looking at a bar graph of their projected marginal tax rates, where they might drop from tax rates that are projected to be in the 30s down to the 10 or 12% tax bracket. And they might be in that bracket for 5, 7, 8 years. And so that lower bracket period is an enormous opportunity to convert dollars that you got deductions for, those contributions when your tax rate was in the 30s, and convert them at very low rates. Maybe we're filling up the 12% marginal tax bracket, or maybe the 22, right? But it's a meaningfully lower rate than what you would have paid had you not deferred them into your retirement plan. And so we got a big tax deduction, then converting them during that period of lower tax obligations, right? We pay a little bit more in taxes to proactively move money from the pre-tax account into the Roth account. That transfer triggers tax at ordinary income tax rates, right? But we're doing it at a lower rate. And then we often see that required minimum distributions are going to push clients back up into higher tax rates once they get into their mid to late 70s and beyond. And so we're trying to exploit that trough, that low period of projected tax obligations by getting as much of that money converted from pre-tax to Roth at low tax rates. And that can drastically reduce the total tax obligations that someone faces over the duration of their entire retirement. And failure to plan ahead and look at pre-tax versus Roth contributions and Roth conversion strategies sometimes results in clients that were very, very good savers during their working years ending up being in very, very high tax rates in their later years if they don't take advantage of that lower tax opportunity in that very early portion of retirement. It doesn't exist in everyone's financial plan, but it's a pattern that we frequently see and like to take advantage of because I'm in Minnesota. I like to say systematically disinheriting the folks in St. Paul and Washington is a worthy objective, and so we try to do as much of that as we can within the law.
Thanks, Brian. There is just a clarifying question I want to make sure I address here. Some people are asking when we say your advisor, what does that mean? Well, most people who work with a dedicated advisor here at MPPL, when we say your advisor, that's who we're talking about. But just know the way we work as a firm is we work as a team. So if your advisor, let's say, is working with you, but isn't a specialist on the 529 plan rules, they may want to bring in one of our advisors who is. And so just know if you ask a question of your financial advisor, the one you meet with for regular reviews, they should be able to answer a lot of these questions. But if they don't and they need to bring somebody else to the table, just know we all work together and we're happy to assist each other. So you don't need to kind of reach out to the specific person with the specialty. We'll make sure you get that advice. Okay. All right, so now there's another question from Beverly. It says, what's the best way to fund education if you've already had something in place, and do we roll anything over? I think this is a good question, and it really relates to some of the things Brian was talking about, but I can maybe address it since he took the last one. So I would say absolutely, if you have already put money away for a child, and let's say you've used things like UTMAs or UGMA accounts, or you've just done non-qualified brokerage accounts or 529 plans, given the new rules, I absolutely think it opens up the door to reassess the options that are available to you. With all of the new abilities to use 529 plans and the ability to roll 529 plans over to Roth and use for all these other purposes, I really believe 529 plans are becoming much, much better and the ability or the risk of getting money stuck there and then being subject to penalties or excess taxes on withdrawals for non-qualified purposes has been diminished. Really, they make 529 plans much more attractive. As financial advisors over the years, we've always had to balance out the tax benefits of 529s with the risk of getting money stuck there. And so this helps shift the needle away from the risk of getting it stuck there side. So I think it's definitely worth some considerations here. So, but this is a highly personal question. I don't think we can address sort of every variation on this in a webinar format, but certainly if you have stuff already saved or if you're considering more saving, just because we've suggested you do it one way in the past doesn't mean that's the way we should do it going forward. This new law changes enough where I think it results in a rethink of the strategy as a whole if you're in this bucket. All right. There is a question from Joe, and he just asked, what is tax harvesting and how do we benefit it in retirement? Although I don't know if this has a whole lot of relation just to the OBB in general. Brian, maybe you can kind of talk about how we deal with tax harvesting.
Yeah, so tax harvesting can take a couple different forms. Probably the most common form is if someone has investments that are held in a regular brokerage account, so it's not in a retirement account where in a regular brokerage account you owe taxes on dividends, capital gains, things like that that are realized throughout the year. If there are securities that are trading at a loss, you can sell those and capture that loss. You're realizing the loss when you sell the position, and then you can use that loss to offset future gains. So that's something that we like to do opportunistically. If we have a position that's at a loss, in the last few years, there's been very little opportunity to do any loss harvesting because stocks have performed so very well. So that's a strategy that's been less utilized in the last few years than what we would have normally seen over history. But there's another way harvesting can be used that people don't often contemplate. And so for people who have the ability to have their income be low or suppressed, particularly in the early years of retirement, at the same time we might be contemplating Roth conversion strategies, it's possible that someone could be in a position where they would qualify for 0% long-term capital gains on their federal income taxes. And so while state capital gains taxes may still apply, there's sometimes a situation where it makes sense not to harvest losses, but actually to harvest gains. If we can get those gains harvested at a 0% federal capital gains tax rate and redeploy those dollars within the portfolio. So, depending on the unique nuances of your tax situation, loss harvesting or gain harvesting might be a viable strategy. And those are important things to discuss with your advisor and make sure that as your taxes are getting drafted, that you're ensuring that your advisor gets a copy of that completed tax return so that we have a consistent check on where your tax filings are landing. And that helps us have maximum context as we try to advise you through these types of opportunities.
Good. Thanks, Brian. There is a question here about from Alex. How does this bill impact charitable giving? So I will admit this is not this area focused most of my attention, but I'll give you what I think I know. But again, this is another one of those areas where we might want to get a CPA involved to dial this in. But as part of the Tax Cuts and Jobs Act, there was this ability because they raised the standard deduction so incredibly much. There was a whole lot of people who would have lost the ability to essentially deduct any of their charitable giving because they were no longer itemizing. And so it created a kind of an above the line deduction. And so if we remember kind of to Brian's earlier topic, this allows people to make a deduction even if you're not itemizing on charitable giving. Well, that deduction as the OBBB is now, I believe, $1,000 for single filers and $2,000 for married couples. So that essentially means that if you are not itemizing your deductions, you can still benefit by giving money to your local charity in the form of cash. Okay. But this does not qualify for contributions to donor advised funds or private non-operating foundations, I believe. So the one thing we always kind of talk about is if you're thinking about donor advised funding, right, then you have to be giving enough to breach the threshold for itemized deductions, or itemized deducting already. If you're going to give directly to the charity, then you have this above the line deduction. But there also has been some things that were going to expire as a result of Tax Cut and Job Act that have now been made permanent. And that is the ability to deduct up to 60% of their AGI for cash contributions. That is now a permanent thing that was going to go away. And there is some special non-refundable tax credits for giving money to K through 12 scholarships that were not there before, I believe. And so there also was a negative for those people in the highest income tax bracket. There are actually some caps starting in 2026 on what can be given and the amount that can be given for 2026 and beyond. And so these are, if you're doing a significant amount of charitable giving and you're in the highest marginal tax brackets, this will be an important thing to kind of focus on to make sure you don't lose some of those deductions. All right, and then looks like there was a question from Michael about what programs were being retired or ended at the end of September. As of I'm aware, the only one that I know of is the EV tax credit. So if you're buying an electric vehicle and you're trying to get a tax credit for that purchase, that is ending at the end of September. I believe that is the only thing I'm aware of. Brian, are you aware of anything else?
I don't have anything to add.
Okay. And then one of the last questions we'll probably drop into today before we have to sign off is from Joyce. She asked a question about how gold, investing in gold fits into the OBBB and gold investments in the stock market versus physical gold. I would say there's nothing in OBBB that generally makes investing in gold any different than it was before. But I think there has been some talk around investing in gold and precious metals around the fact that the OBBB creates more deficits on top of the existing deficits and debt we already have in this country. And there's, that has the ability to create inflation or printing more US dollars to pay for our debt. And there's belief that if you buy gold and physical assets, gold is just one of many, that physical assets will tend to perform well in high inflationary environments. And so, yes, there may be some benefits if we experience high inflation or the deficits keep soaring. That's kind of, I think, the idea where people talk about gold investing as a result of the OBBB, but I don't think there is any specific tax or investment benefits of the OBBB relating to gold investments specifically, unless, Brian, you know of any.
Yeah, no, gold just remains one of the 32 asset classes that we track in our proprietary models. And so we'll allocate to it in some of our strategies opportunistically. And there are time periods when it makes sense to have a gold allocation and time periods when it makes sense to avoid a gold allocation. So we view it as an area to be more nimble versus tying up a large proportion of one's investment capital in something that probably has lower long-term appreciation potential.
That's good. Thanks, Brian. And there are some other questions that are related more specifically to other topics not related to the OBB. So we're going to kind of not answer those today. I think you could run that by your specific advisor. But those are the majority of the questions on the OBBB today. So with that, I think we're going to sign off. Hopefully you all enjoyed our presentation. We will get a webinar or a recorded version of this available for people if they want to review it. And as always, if you have any questions, don't hesitate to give us a call. We're here to help.